All right, so we are going to look at a couple of questions from budgeting and control. And the first question you're going to look at is called glove core. When you look at what they're asking for us to do is to calculate total labor rate and total labor efficiency variances for the last quarter. Then analyze the total variances in two components for planning and operational variances in much detail as you can, and assess the performance of the production manager for the last quarter. Before I even look at the question, I would like to let you know that when it comes to budgeting, the most that you need to know about variances. Variances that have to do with materials, labor, overheads, and you need to know that these variances can be split further, because when you look at the variances that we saw in management accounting for the level 1 paper, and then they are the ones that you continue with right into this, but they are split further. And you need to know what these variances mean and of course how to calculate them. So given that you have, I think, 1 more week, you need to make sure that you have understanding of this one if you don't already. So if we are to look at this, I think this one will give us some idea of some of these variances. So they're saying that glove makes high quality hand badge. Okay, so they're saying that Glove.com makes high quality handmade gloves, and it sells them for an average of 180 per pair. Standard cost of labor for each pair is $42, and the standard labor time for each pair is 30 hours. In the last quarter, Glove had budgeted production of 12,000 pairs, although actual production was 12,600 pairs to meet demand. That 7,000 hours were used to complete the work, and there was no idle time. Total labor cost for the quarter was $531,930. At the beginning of the last quarter, the design of the gloves was changed slightly, so this is important. The new design required workers to sew the company logo onto the back of every glove made, and this estimated time to do this was 15 minutes for each pair. However, no one told the accountant responsible for updating standard costs that the standard time per pair of gloves needed to be changed. Similarly, although all the workers were given 2% pay rise at the beginning of the last quarter, accountant was not told about this earlier. Consequently, the standard was not updated to reflect these changes. And when overtime was required, workers are paid 25% more than their usual hourly rate. So, now, if we are to extract all of the data which is in the table, so we have the standard cost, so we're looking at glove core. So we have standard labor cost, which is 42. And this is standard labor cost for each pair. So this is per pair. Then standard hours, 30 hours. Therefore, you can get standard labor cost per hour as a division of these two. So from here, we have been told that they sell the average for 180 per pair and so on and so forth. So, but what I was expecting for the starters is the standard cost. So now, to calculate the total labor rate and total labor efficiency variances, so labor rate has to do with the rate which was supposed to be charged and the rate that was actually charged. So the actual rate, we need to determine what the actual rate was. Okay, so now to get the standard labor rate variance, we look at the standard rate. Then we look at the actual rate. Then we can determine the variance. In terms of rates, then we can look at how many hours. So now, the standard rate, we already know it. It's 14 as we have calculated it. But what was the actual rate? So for actual rate, so they made actually 12,600 pairs and they used 37,000 hours and total labor cost was 531,930. So it means that we can actually get this as 531,930 divided by 37,000. The actual rate ended up being higher. So, therefore, to get the labor rate variance, we shall get the standard multiplied by the actual hours, which is 37,000 hours, subtract the actual rate multiplied by the actual hours, 37,000 hours. So which gives us 13,930. And actually, this is adverse. And I want you to not only look at it just because you have a negative here. I want you to understand why it is adverse. It is adverse because the actual rate that we are paying at is higher than what was the budget. So it means that we are paying people more. So if you understand it that way, then the sign doesn't matter, because somebody may have made a mistake and started with this minus this and you get a positive. But the issue is the variance is adverse because the rate is higher than the budget rate. So that is the labor rate variance. Now, then the labor efficiency variance. Now for this one, what we are looking at is of the labor, that the hours that we had, how did we utilize them? So that is, if we look at what we were supposed to produce, if we are looking at the hours that were planned vis-a-vis what we actually produced. So So we are going to look at, if we are to look at the units, okay? The units are 12,600 that were actually produced. And each one was supposed to take 3 hours. So what are the standard hours for actual production? Okay, and you should note that I'm saying the standard hours for actual production. So these ones we said they are going to be 12,600 multiplied by 3 because the standard hours were 3. You can actually link this one here. So that is 37,800 standard hours for actual production. So what are the actual hours? Actually, the actual hours were 37,000. So what this lets you know is that we had planned to use 3 hours per unit. We should have only used 37,800, but we actually used 37,000. It means that actually we used less. Okay? So the labor efficiency variance will be, of course, you get this minus that. Okay, but that one gives you the difference in hours. So you have to multiply by the standard cost per hour of 14. So you get 11,200. And because, like I told you, that in this case we actually used less hours than we should have used, so this is favorable. Okay. So before we proceed, is there any problem with this computation that I've done just now for these two, or are we okay with them?
Yeah, I am okay.
Okay. Okay.
So
So,
it's okay on my end.
all right. So this is the labor rate and labor efficiency variance. Now, this is where we normally stop. But in this case, they are also telling you that some things had changed that may have contributed to these variances. And this is what they are saying here. That at the beginning of the quarter, the design of the gloves were changed, that the new design required you to sew the logo, which took an extra 15 minutes. Which means that the revised standard hours should have been actually not just the hours that we have used before. We should have added 15 minutes there. But no one told the accountant, so the accountant didn't update. Also, although workers were given a 2% pay rise, the accountant was not told, so they did not also account for that. Which means that for each of these variances, we can break them into planning and operational variances. So planning variances have to do with what has changed with the standard, and operational variances now have to do with the effect of what has happened even with the new standard. So if we look at planning and operating variances or operational variances, so we can start with the labor rate. Okay, so we can say labor rate planning variance. Now for the planning part, so we can say what was the original standard. That one we have it here. Okay, the standard rate was 14, original standard was 14. So I can say original standard. And I just say that was 14. And remember, these are $14 per hour. Okay? But actually what had happened was they had revised, okay? They had revised the standard because they had given everyone a pay raise of 2%. So the revised ought to have been actually this one, but multiplied by 1.02 to increase it by 2%. So it should have been 1428. And therefore, because the revision increased the rate, therefore, the labor rate planning variance is actually this 14 minus the 14.28. So that gives you, multiply by the what? Because this one gives you the rate per hour multiplied by the 37,000 hours. So that gives us 10,360. And again, it is adverse because the revised standard is higher than the original. So we are paying people more, so that is adverse. So that's the labor rate planning variance. Now we can have also the labor rate operational variance. So now here, it means that we are starting with the revised standard. And we are saying, okay, if it was 14.28, what was now the actual? What was the actual rate? 14. I think this one is not exactly 14. It is 14.38. Okay, when you round it. So again here, it seems that even with the 14.28 revised standard, we actually paid more. So we can now come and say that the labor rate operational variance is equal to, again, 14.28 minus 14.38 times the hours, 37,000. So which is again adverse because again the actual rate is higher than the revised standard. And you can see if you add this to this, you get the original 1390 that we had before. So this is just splitting, trying to explain what portion of this variance is because of planning and what is because of operational causes. So they have to add back to that figure. So that is the labor rate operational variance. Now we can get the labor efficiency, also planning and operational variance. So planning variance. So now for the planning variance, we start with the of course standard hours for actual production, which should be 37,800. Then these are the original. So I can say original standard hours for actual production. And remember how we got these? We got them by saying we are saying 12,600 for the standard hours, which is 3. But actually, the revised one, okay, revised standard hours, so of course it is still 12,600, multiplied by, we are going to have this, okay, the 3 hours, but remember they have added 15 minutes. 15 minutes out of 60. So the figure turns out to be now 49.50, which means that they are assuming that this is the original 37,800, but the revised one is 49.50. So the revised standard requires us to use more hours. Okay? So that means that the labor efficiency planning variance will be again these hours minus these hours multiplied by the standard rate per hour, which is 14. So which gives us 44,100, and it's adverse because the hours that are revised are more than the original that were planned. And then finally, the labor efficiency operational variance. So here you start with the revised standard hours, of course, which is this. Then the actual hours that were used. As we know, we used 37,000. It means that although the revised hours that were expected were 49.50, the actual hours were actually less. And then we can have the labor efficiency operational variance being the difference between this and that, again multiplied by the 14, the standard rate. Okay, which is again 55,300, and it's favorable because we used less hours. And again, I said when you add this and this, you get back the 11,200 that we got up for efficiency. So again, it's just a split. So those are the variances that they told us to split. Okay. Now we go to the last part, where they ask us to assess the performance of the production manager for the last quarter. So assessing performance here, you would have to first say that the manager should be assessed on what they have control over. That is one thing. And then you can now start talking about labor rate variance. So labor rate variance was 13,930 adverse, with the planning. So for the labor rate, even the planning was adverse. And then the operation was also adverse. Okay, so that is the first statement you can make about labor rate variance. Now we need to say what is the manager responsible for and what they are not responsible for. Okay, so this manager here, they're saying the new design required workers to sew a logo, but no one told the accountant responsible. Also, they gave the rise, but no one told the accountant again. But the production manager, you need to know what they are responsible for because they are only in the production facilities. So, for the production manager, perhaps this badge that they are saying we should add is not their control. Perhaps. And so if it's not in their control, then you cannot blame them for this 10,360 adverse because that was created because of the planning change. However, you can gauge them on the operational variance because even after they revised, the actual turned out to be still adverse. So you can say the production manager may not have control over the planning variance because perhaps it was not his decision to sew the logos on the gloves, okay? However, the operational is well within his control, and thus he failed on it given the operational variance was adverse as well. So that is what you can say for the labor rate. Then you can now say again labor efficiency variance was 11,200 favorable, I guess. Yeah. 11,200 favorable, which included an adverse planning variance of 44,100 and a favorable operational variance of 55,300. Then you say, if the production manager was responsible for the 2% increase in salary, they can be blamed for the adverse planning variance. But most likely, they were not in control of this decision. Then you say, however, the production manager is responsible for the operating variance and they performed well with a favorable variance of 55,300. Overall, the production manager did well with a total labor variance with the total operating level variance of, so you can actually tell if you get this and this, you get 51,730. 51,730 favorable. Because what could have happened is that you actually, when it comes to the rate was increased, but given that the rate was increased, people worked better, and that's why we used less hours. So, and that could be something that the production manager is responsible for. So this is actually how you can appraise him on that. So that is how you would calculate this question. I don't know if you guys have any questions on that, or it's clear.
Yeah, on my end.
Okay. So, okay, this is just one of those questions where you have to deal with these variances. There are plenty others, and I think we should do just one more. And then, as I said, the rest that you see that you may not know about, you need to go and do the questions. I need to see if you can get some summary of them, especially how they calculated, because you can always reason them out in the exam, but it also helps better if you know the calculation, so that when you are doing, you save time, because time is of the essence when you are doing the exam. So let us do this question called Kappa. And this question here, they're asking us to calculate the following variances for the last month. So material usage variance for each ingredient and in total material mix variance, and then material yield variance. And then discuss problems that the current system of calculating and reporting variances for assessing the performance of the production manager. So but basically here what they are telling us is to calculate material usage variance, material mix variance, and material yield variance. And then, of course, the current problems with the current system. So we are going to see what they are talking about here. So, but when you go to the material, you can see that Kappa produces omega, an animal feed made by mixing and heating three ingredients, alpha, beta, and gamma. And the company uses a standard costing system to monitor its costs. So this is the problem that they may be asking you to talk about, and also how the variances are being mentioned, as we shall see. So standard material cost for 100 kilograms of omega is as follows. So it has 40 kilograms alpha, 60 beta, and 20 gamma. That's 120 kilograms. So now we can have the cost here, and then we have now the cost per 100 kilograms of omega, 80,320. Understand that the mixing and heating process is subject to standard evaporation loss. So that is why we need 100 kilograms, but actually we have 120 kilograms here. So there will be some loss, which is most likely the 20 that is lost. Now, alpha, beta, and gamma agricultural products and their quality and price varies significantly from year to year. Standard prices are set at the average market price over the last 5 years. Kappa is the purchasing manager who is responsible for pricing and supplier contracts. So now this is the issue. They are using standard costs, but the prices vary significantly from year to year. So they just get an average over the last 5 years. So the standard price that we are seeing here is not very good because of the fact that it is an average for the last 5 years. And that's the question they're asking us in the second part. So for the first part, of course, we are going to just calculate, but we should know that when you answer in the second part. They're saying that the stand mix is set by the finance department. The last time this was done was at the product launch, which was 5 years ago, and it has not changed since. So that's another problem. And then last month, we had 4,600 kilograms of omega produced. And this is what they used. At the end of each month, the production manager receives standard cost operating statement from Kappa. The statement contains material price and usage variances, labor rate and efficiency variances, and overhead expenditure and efficiency variances. No commentary on the variances is given, and the production manager receives no other feedback on the efficiency of the omega process. So this is what they are really asking us to discuss in the second part, even the other part we have said above. So the manager just receives material price and usage variances, labor rate and efficiency variances, and overhead expenditure and efficiency variances. And they do not give commentary on the variances. So they don't explain why they are adverse, why they are favorable, what's the cause and all that. They just give them figures, and there's no other feedback. Okay, so let us start with the calculations. So we are going to start looking at materials usage. So materials usage, as the name suggests, of course, you're going to look at what you should be using and what you actually used. So now, if you look at here, this is what we should be using. So for alpha, this is how many kilograms, right? That is per unit. So here they are giving us 40 kilograms, 60 and 20. That is the what should be used. And then they are telling us what was actually used: 2,200, 2,500, and 920. So now, so to determine the materials usage variance, we should use, so there is actually what we normally term, there's some units that you're going to find. You're going to find things like actual quantity, standard mix, things like actual quantity, actual mix. Okay. So this will tell you, like, if you look at the mix, so we also have standard quantity, standard mix. Okay. So we can use this, but if you don't know them, you can just say what should have been used. So what should have been used? What was used? Then you get the variance. The variance here is in kilograms. Then you put the standard cost per kilogram. and get the variance. Okay? But what should have been used is just standard mix. But for the actual quantity, right? So actual quantity, standard mix. So now this is given us for 100 kilograms. So if we are looking at 4,600 kilograms, so for the alpha, it means we shall have 4,600 divided by 100 multiplied by the 40 here. So that gives you 1840. Then for beta, the same. Okay? 4,600 divided by 100 multiplied by 60. And then also gamma, 4,600 divided by 100 multiplied by 20. So we can see that this is actually the actual quantity, but for standard mix. Okay? Then what was actually used is actual quantity, but actual mix. So those ones, you just pick them from here. To 200, to 500, and 920. So you can see that actually you should have used 1840 kilograms of alpha, but you actually used 2200. So it means you used more. So if you get this minus this, that gives you the variance in kilograms. So the variance in kilograms, so is this 920? Yeah. So you can see that we use the more alpha and we use the less beta, but I think for gamma we use the same exact quantity. And you have to sum these up and see whether so you can see from here that like in total you used actually more, okay? Because we are supposed to have to use 5,520, but we used 5,620. So in total we used more. But because the price is different, you can find that even though we used more in total, you can find the variance may not be negative. But let's see. So this is the standard cost 251. 251. So now the variance, to get it, you basically multiply this variance in kilos by the standard cost per kilogram. So that gives us these variances. And of course, even them, when you add them, now this is adverse because of course we use the more. This one here is favorable because we use less. This one here, there is no variance, so we can leave it alone. But now, since the one which is favorable is higher than the adverse, total is actually favorable. So this is the total material usage variance. So here we are calculating the usage variance. So material usage variance is actually favorable. But as you know, they were not providing explanations. Even I think these ones were not given, they just give you variances. So we need to explain why that's not good and of course how to better represent this. But for now, let's calculate the mixed variance. Now for the mixed variance, what we are saying is, had we used 40, 60, 20 in this proportion, what would have been the actual production and the cost? Because here what we do, we look at what is the actual quantity, but for the standard mix, okay? So here we used, let's say, actual quantity, standard mix. Then we have actual quantity, actual mix. So now, this one actually is not actual quantity, is rather standard quantity, standard mix, because what we did with this was saying 46,000 kilograms were produced. So what would it have been? So now for this one, for alpha, remember we have the actual quantity, actual mix. We can just pick these ones, put them here for alpha, beta, and gamma. Now, to get these ones, what we are saying is we are still looking at the same 5620 kilos, okay? 5620 kilos, that's what we are still looking at. But using the ratios that we have of 40, 60, 20. So basically what we are saying is that what is 40 out of 120 multiplied by 5620. Then you go 60 out of 120 multiplied by 5620. And then you go again 20 out of 120 multiplied by 5620. So at the end of the day, you get the same quantity, okay? But in the standard mix. So again, we can copy this. So variance here in the kilogram is that if I had used the standard mix, I was going to use 1873, but now I actually use 22,000. So it is adverse. If I subtract here, I get that it's adverse. If I do the same for this, I can see also this is favorable and this is also favorable. So we don't have to have the decimals, we can round them. So then the standard cost, of course, we can still bring the standard cost of 251. And then we can get the variance. Okay? And when you add, of course, this one here is adverse, this one here is favorable, and this one here is favorable, and the total is also favorable. So that is the materials mix variance. Okay? Any questions on that?
No, my goodness.
This is okay.
Okay. So we have answered. Now we need to get the material. material yield variance. So material yield variance, so this is the standard quantity standard mix. So now when you come to the material yield variance, so here yield means output. So what we are saying is that if we wanted to produce 600 kilograms of omega using these proportions, okay, what would be the input? So we compare with the standard quantity standard mix, and I'm just going to copy these ones. Then we now compare with the actual quantity standard mix. So basically what we are saying is this is what was made using the materials, but if at all we had used the standard quantity and there's the normal loss, that would have been 5520. So we used actually more than what we should have used. So from here we can just get the variance. So you can see that all of them are adverse, because if you look at them, for all of them, the standard quantity would have been 1840, but we used 1873. Then even here, 2760, here 2810, 920, 97. So we used more of everything. So that is what explains our variances being adverse, all of them. So, and you can see the standard cost here. We can just copy it this side, and then the variance. So you can see that this is adverse, this is adverse, this is also adverse. Even the total is adverse. Okay. So that is the material yield variance. The other thing that you can think of is that if you use the 5620, okay, if you use the 5620 kilos, what were supposed to have produced and what did you produce? Okay, so this 4600 is less than what you would have produced if there was no normal loss. So that is what we are saying here, if the loss was not there. So this is the material. So for materials, we have usage. Also, we have price variances for material. But when you have more than one input, then you can also have mix variance and also yield variance. Okay. So second part here says discuss problems with the current system. So the problems, first of all, they are saying that the production manager receives the standard cost operating statement. It contains material price and usage variances. So the first problem is that material price is outside the control of the production manager. So probably he's not interested in it. Okay? Because remember, we had said that it's better to give somebody what they can control. And the production manager does not control the what? Does not control the price of the materials. So that is one thing. And second thing, there is no split for planning and operational variances. Okay? Since the planning variances may also be outside the production manager's control. So this is another problem. They're not splitting the variances for materials into planning and operational variances. So it means that they are basically judging the production manager on everything without splitting between what he can control and what he cannot control. Then we have to pick things that were taught to us that the standard cost was set 5 years ago. Which may no longer be a realistic standard. And you have to say, of course, standards have to be achievable, realistic, and all that. And the one which is set 5 years ago may no longer represent the actual. Then also, no commentary is provided. Explain the reasons for the variances in the report. So it means that you can't have an idea of what has gone wrong so that you try to correct it. And the other problems that you can find. But remember, they are asking you for problems for 9 marks. So if you explain these ones, very well, then you should actually find that they are providing 3 marks per point. So if you don't explain very well, of course, you may not get 3 marks, but you can get 2. So if you get 2, these are 8. Okay, but ideally, the point is not to write so many points, but rather write points and explain them well. Because the question says discuss. So discuss means you have to provide explanations and also probably examples where possible, or the consequence of, for example, the consequence of no commentary being provided. Don't just write that statement like that because it will not give you the marks you need. So you would say, this means that the production manager may not have an understanding of what has caused the variances and may not be better suited to change anything to actually make the variances become favorable. So you have to provide context. You have to provide meat to whatever you have put as a text there. So, any questions? No?
No questions from me.
Okay.